Hello and welcome back to RCLCO's April monthly economic update. I'm Scott Bommarito, and today we'll talk through a couple of the recent developments in the U.S. macroeconomy. One of the major developments of the last month was also one of the most widely predicted developments, which was an increase in the consumer price index reading, which accelerated to 3.3% in March. That's the highest level it's been at in almost 2 years at this point. That, of course, was driven by a sharp increase in energy prices, which rose 12.5% over the last year, driven by the war and continued conflict and shipping complications in Iran that have shut down shipping in the Straits of Hormuz. Again, this was widely predicted as expected, and remains to be seen what happens in the aftermath of the ceasefire that's been negotiated and is continuing to develop. So we'll look for this temporary shock in energy prices to most likely decelerate in the coming months. But for now, we're left with high oil prices, which have trickled down to high retail gasoline prices. So as the line chart on the right shows, both of those have spiked to their highest levels since the war broke out in Ukraine back in early 2022. So as of last week, US retail gasoline at the national level averaged $4.25 a gallon, which is somewhat lower than the spike in the war in Ukraine, but we expect gas prices will likely increase still over the coming weeks. Brent crude oil prices rose to $124 per barrel. That's actually modestly above the early 2022 spike. And again, it remains to be seen how much runway energy prices have to continue increasing, and that will be largely dependent on what happens with the negotiations about the Strait of Hormuz. Elevated inflation has put upward pressure on long-term interest rates again. So the 10-year US Treasury yield rose from right around 4% earlier in the year to as high as nearly 4.5% in the immediate breakout of the Iran conflict. Rates have since come down modestly and are at about 4.3%. As of the time of recording, they're at about 4.25%. But long-term rates do look poised to remain elevated in the midterm. Further down the yield curve, we had some rather notable developments in that the 2-year yields rose above the 3-month yield. So further correction in the yield curve, moving away from the inverted yield curve, where short-term rates are longer than long-term, the short-term rates are higher than long-term rates, excuse me, which has been the norm for several years at this point. So this is the first time since December of 2022 when that midterm 2-year yield was actually higher than the 3-month yield. So this is in general viewed as a positive sign of normalization in the interest rate environment, albeit at higher levels than we saw a few years ago. Continuing the trend of interest rates, we've also seen the recent uptick affect 30-year fixed rate mortgage rates, which rose from about 6% up to about 6.4% again in the aftermath of the Iran war. The 30-year mortgage rate has largely corrected its spread to the 10-year. That's normalized right around 200 basis points, which is near its long-term average. That's after several years of an elevated spread where mortgage rates outstrip the 10-year US Treasury yield by a higher margin than historically. Elsewhere in the employment sector, we saw a stronger monthly job growth reading in March of about 180,000. That followed a fairly substantial decline in February. However, the recent employment data have been incredibly volatile, as this chart on the right shows, with large corrections, almost exclusively downward corrections, with one exception of the January report. And looking forward, we expect job growth to continue to be modest. Largely, that's due to slowing US population growth and slowing immigration rates in the US. So we'll continue to track these developments. The potential silver lining is that the unemployment rate does remain low. So continuing the trend of a no hire, no fire type of employment outlook, which looks to be durable, at least in the near term. That concludes our April macroeconomic update. Continue to follow RCLCO for new webinars, podcasts, and future updates.